So we're going to continue our lessons, and today we're going to talk about an extremely important area of accounting, which is referred to as the balance sheet. The balance sheet, as you will learn, is an extremely important financial statement, probably the most important one as far as the users of the financial statements are concerned. So today's agenda consists of these few items. We'll talk about what is a balance sheet, fundamental accounting equation, the definition of assets, liabilities, and equities, what does a balance sheet look like, important features of a balance sheet, different types of receivables and payables, and of course how to prepare a balance sheet very briefly, and some of the accounting standards that we're concerned with and principles. So, what is a balance sheet? Well, a balance sheet is formally defined as it states in the slide. It's where the final balances of all permanent accounts are listed and balanced using the fundamental accounting equation. So some of these terms might be brand new for you. For example, final balances. Well, final balances implies that there are not or non-final balances during the year. So remember, a balance sheet is referred to as it's like a still picture. It's a picture on that day. It gives you an idea of the business on that particular time, on that particular day, as to how the business is doing. So, for example, items such as your bank account is listed on the balance sheet, and through the year the bank account changes. But when the balance sheet is being prepared, that day's final account balance is for your bank account balance is put into the balance sheet. So that's what we mean by final balances. And what are permanent accounts? As you will learn in the future, there are non-permanent accounts, and all the accounts that are listed on the balance sheet are referred to as permanent accounts. And of course, the fundamental accounting equation is extremely important. We'll learn that in the next slide. Just give me one sec. So again, formally, this balance sheet provides the financial position of a business on that particular day. So what is the accounting equation? Accounting equation can be referred to as very simply LOE. A equals L plus OE. A stands for, of course, assets, L stands for liabilities, and OE is owner's equity. So these terms are very, very fundamental, very, very important to accounting. So now let's define them. What are assets? So assets are formally defined as all those things that you own that have an economic value in the future. All those things that you own that have a future economic value. And of course, liabilities are opposite of assets. These are all those things that you owe to others that have a future economic value. So assets are things that you own, and liabilities are things that you owe. And of course, owner's equity is the difference. So assets minus liabilities would be your equity. So for example, if you own a car which is worth $25,000 and you have a loan against it, and that loan is worth $15,000, that means your assets are $25,000, your liabilities are $15,000, and your owner's equity, which is your part of the asset, is 25 minus 15 equals $10,000. The most important accounting equation that you'll ever come across is this fundamental accounting equation. A equals L plus OE, LOE. So this is extremely, extremely critical for you to understand. If you have any questions about this, you should refer to the package. You should refer to your notes as we go along in this course. So as I was explaining what these items stand for, you can see in this slide that assets are all those items that a business or you own that have future economic value. Now, why do we say as accountants that they must have future economic value? Because assets have to be financially put into the balance sheet. So they have to have a value for you to actually put in the balance sheet as an ending balance for that period. You cannot say that, this is my asset, yet it has no value. If it has a zero value, then it has nothing to put on into onto the balance sheet. So they have to have a future economic value. And same thing with liabilities. These are also, the liabilities can also be referred to as claims against the assets. So in my example earlier that I gave you about the car, the $15,000 loan is something that is against the car, meaning if someone has given you that $15,000, they can either ask for those $15,000 back from you, or they can ask you to sell the car and give them $15,000. Or if you don't sell the car, they can simply repossess your car and then take the $15,000 from that and give you the difference. So that's how liabilities are referred to in life, and of course in the balance sheet they are an important part. And the owner's equity, as I had mentioned earlier, is the difference between assets and liabilities. This is what exactly the owner owns in that business. Now, what does a balance sheet look like? This is a very, very rough example, but just to give you an idea of the three components. But before we even get into the three components, take a look at the heading. The heading is really important as far as accounting is concerned. This is just to have uniformity among all different businesses and people to ensure that people can understand what these statements look like. So you can take a look at the first line is the name of the business. So a balance sheet can also be prepared for individuals. So if this was being prepared for you, you can put your own name as the first line. And because it is being prepared for a business, the business's name goes on the first line. The second line states what financial statement it is. So in this case, it is a balance sheet, and clearly it states balance sheet. And then of course the date. So we need to know as the user what date this balance sheet is being prepared at. So in this case, it is December 31st, and the year can be subjective. And then you can see that it has three components: assets on one side and liabilities and equities on the other. So this is just for simplicity reasons. Assets are listed on one side, and then the other side, on the right side, there are the liabilities, and then of course the owner's equity. Take a look at some of the small features. For example, that the assets are all listed, and then there's a title called total assets, and then they are totaled. In this example, they're totaled at 49,121, and then you can see the liabilities are first totaled at in this example 14,956, and then of course you have the owner's equity, and the total liabilities and equity is also 49,121, which is the same as the total assets. So assets equal liabilities plus equity. So that's how balance sheets are prepared. This is just an example. In this course we will learn how to come to this kind of preparation of balance sheet. So you'll do lots of different types of exercises and assignments where you'll become familiar with balance sheet and other financial statements. I have just gone through the important features of a balance sheet. So they are listed here on this slide as well. You can take a look that they are balanced using the accounting equation. And then of course you've got the three-line heading. The three-line heading again is who, what, and when. So the name of the person or the business, the name of the financial statements, and of course the date on which the balance sheet or the financial statement is being prepared. Some of the important features of balance sheet. Now some of these features or some of these concepts can be challenged or are also not in practice in all forms of accounting globally, but generally speaking, this is how the assets and liabilities are listed. So you can see that assets are generally listed in the order of liquidity, which means, liquidity means the order in which assets can be most quickly converted to cash. So cash or bank account is the most liquid asset, which means that it is already cash. And then of course the rest of the assets are listed in the order of liquidity. How soon can you convert them into cash? liabilities are listed in the order in which they are normally paid. So certain liabilities are paid regularly or early on during the year, and certain liabilities are long-term liabilities. So we'll get into all those details as we go through this course. And you can again see from the example, if you refer back to that slide, you can see that there are two final totals: total assets, total liabilities, and equity, and they are equal to each other. So this lesson is quite lengthy. What we will do is we will stop at this point and continue tomorrow from the next slide onwards. So thank you for listening, and remember, as always, ARTW, accounting rules the world.